Well, I'm one of your hosts today, Lyman Jackson, a partner here at Financial Planning Solutions. We have our special guest, Gary Weinman, who's a CPA with Cherry Beckert. Have I got that right, Gary?
That's correct.
Cherry Beckert. It's a CPA firm, national. And before we get started with that, just want to introduce the team here in case any of you uh, haven't met some of the folks here that work at Financial Planning Solutions. So let's start with Andrew,
Nice to meet everyone. Andrew Holmes, financial planner here at Financial Planning Solutions.
Rick,
Rick Fingerman, Financial Planning Solutions. Good to see you all.
Maggie,
Maggie Dolan, Client Service Specialist. Good to see you.
and, and Dylan.
Hi, everyone. Dylan Driscoll. I'm a power planner here at Financial Planning Solutions.
And we're happy to have Gary Wyman join us today. Gary and I have actually known each other for a long time, and he'll tell you how a little bit about how we met. But we both live in the same town, and we met each other through the Boy Scout organization there when our sons were both in scouting. And today we're going to talk about year-end tax planning tips. And Gary's an expert in this area. We have a number of shared mutual clients with Gary, and I want to hand it right over to Gary. And let's get started.
Okay, thank you, everyone. So let me get the screen sharing started. Is it working?
It is. And just one additional administrative thing I'll just mention is that if you are joining, since we are recording this, we would like you to turn your cameras off unless you're presenting like Gary is. And that's just for regulatory purposes. Thanks very much.
Okay. So start off, we do have a disclosure from FPS. Basically, this is for educational purposes, and anything you hear, make sure you consult with people before you do anything with what you hear today. That good enough, Lyman?
Perfect. Thank you, Gary.
My pleasure. Okay, so who am I? I'm a tax partner at Cherry Beckart Advisory LLC. We are the 20th largest CPA firm in the country. I used to be a partner at Katz Solomon, and then in 2024 we merged in with Cherry Beckart. Cherry Beckart's rapidly expanding their footprint in New England. Since then, we've bought two other firms and, growing our footprint in the Northeast. Personally, I have over 30 years of experience providing tax services to high net worth individuals, real estate professionals, and business clients. And as Lyman mentioned, met through Boy Scout Troop 1775, where both of our sons earned their Eagle Scout badge. And as of today, the troop still hasn't kicked either one of us out. Myself, I am the committee chair, and Lyman, who was our former scoutmaster, is now an assistant scoutmaster. And one of the nice things, which I think we both like about our troop, is that a lot of the dads, even once their kids get their Eagle and age out, they stay involved because we have a really good program running, and met plenty of great people, and Lyman is one of them. Okay, so we're going to start off with some stats. The IRS provides the raw data, and then there's an organization called the Tax Foundation that summarizes them. And the most recent data is from 2022. In 2022, taxpayers filed about 154 million tax returns, reporting almost 14.8 trillion in revenue, and they paid 2.1 trillion in individual taxes. So that should give you a general scope on what's involved. So then who's paying all these taxes? Well, if you're in the top 1%, your average tax rate was 26.09%, and you were responsible for 22.4% of all the income in the country. And on that 22.4%, you paid 40.4% of all the taxes in the country. And in order to be in that top 1%, you needed to make $663,164. The next slide is the one that always kind of scares me a little bit, because what's the top 10%? The top 10% had an average tax rate of 21.11, but they earned almost 50% of all the income in the entire country. And they paid 72% of all the taxes. And here's the one that always disturbs me the most, is that to be in the top 10%, you only had to make 178,611. Now, I said these are the 22 numbers, and these numbers go up every year, but they've been kind of consistent. And I'm curious when the 2023 numbers will come out to see if we're getting closer to 200. But the point of this is, here in New England, especially Eastern Massachusetts, we're in a high cost of living, if not a very high cost of living area. And it's not, outside of this of reasonableness for a married couple with two people earning to easily make that 178,000, depending on what they're doing. And, so I always tell people when they're saying, rich people, here in the high cost of living states, it's really easy to be classified as being rich when I don't know a lot of people that are making under 200,000 like this, that if you ask them would consider themselves rich. If anything, they're probably up to their eyeballs in debt. Okay. Quick TikTok. So as you know, a lot of people, they like to get their tax information using social media. And I always like to, bring them up and either say if they're right or they're wrong or what's happening. So one of the ones that a lot of people have been complaining about recently is when you go to Target or any retail establishments and they ask you, do you want to round up and have the money go to charity, or do you want to, make a donation, at the checkout? Well, the general consensus is that these large corporations are using your money to make donations and save on their taxes. So the question is that true or is that false? Well, the answer is that's false. Um, these corporations are not getting a deduction for any of these payments. What's really happening is when you sign up to do this, it's a liability to them, and they're just acting as the middlemen to, get the money to the charities. Now, not going to lie, they do get to, show up with a big check and it'll say that, they made, that they collected X for the charity, but they're not saving any tax money on that. When you do this, that tax, that charitable contribution is yours, and you should save your receipt so this way you can take that deduction on your own tax return. Okay, the big change in 2025 was the One Big Beautiful Bill Act, which they were unable to change the name no matter how badly they wanted to. The very first thing I'm going to talk about here is the research and development capitalization. Now, this is more directed towards corporations, but it was probably the most significant thing in the bill. So I'd be remiss if I didn't mention it. Gone are the requirements for businesses to capitalize their R&D expenses and amortize them over 15 or 30 years, depending on where the research was done. This was a huge problem for Massachusetts. All of our high-tech businesses and life sciences, they breathed a huge sigh of relief. We were running into situations where there were companies that had no revenue, but were ending up owing taxes because of not being able to deduct these things and having them be an add back. It was a huge problem for the past 2 years. Luckily, it's now done, and they also set in motion ways to get all those taxes that these companies were paying back. So that's a huge relief. Back onto individuals, which is more of our focus for today's meeting. The standard deduction, they increased it and it's permanent. For individuals, it's 15,750. For married people, it's 31,500. The child tax credit, this one was a really important one to get passed. It had been used as a hot potato for years. It is now permanent. It's increased to 2,200, and even better, it's now going to be adjusted for inflation. So this way, it's not going to be something that's going to be tossed around between the political parties on what is it supposed to be? Should it go up? Should it go down? Should it be done away with? You know, without Congress completely changing everything, this is going to be on autopilot for the rest, for who knows how many years, and that's a really good thing. Next up is the state and local tax deduction. This was an issue for the high tax states because you were limited to being able to deduct 10,000 in taxes. But if you lived in a high tax state, between the state taxes and your real estate taxes and your auto excise taxes, typically you were shooting way past that $10,000. And a lot of people weren't even itemizing because of that. So now they raised it up to 40,000, but there's also a phase out. Between 500 and 600,000, it starts to phase out. After that, it goes back down to the 10,000. But this is going to enable a lot of people to itemize their taxes in 2025 and beyond. Now, the next one is there's now an itemized deduction limitation. This doesn't take in effect for 25. This is more of a 26 issue, in which the highest bracketed people, people that are in the 37% bracket, basically they're going to be capped at 35% for their deductions. And, I have a tax tip on this a little bit later, which relates to this charitable contributions. Because also based in 2026, there's now a 0.5% floor on charitable contributions. So basically what that means is for every $100,000 you make, your first $500 of charitable contributions are not deductible. Now, this, for most people isn't going to be that large of a deal, but it is going to impact a lot of people that are making large contributions in specific years. So that's why the first tax tip we're going to run into is if you're considering a sizable charitable contribution, 2025 is probably the year to do it, because in 26 you're going to have two things that are going to be limiting your contribution. So something to consider. Okay, now as I had mentioned, there's more deductions that are going to be involved in 2025. So because of that, the alternative minimum tax is going to be rearing its ugly head again. It's basically disappeared for the past couple of years, but we're anticipating to seeing a lot more people get trapped by it than in the past. So if you're someone who used to be in the AMT, it might make sense to, consult your tax professional and get some projections done to see what you can do before you start doing things, because, you don't want to do something that's not going to benefit you at all because of the AMT. Another one that's been talked a lot about is the senior deduction. There's a new $6,000 deduction for those that are 65 and older. However, it also starts to phase out based on income. And if you're single, it's gone at 175,000. If you're married filing joint, it's 250. I've run into this with a lot of people that thought they were going to get this in 25, but their income is way over the 250,000 and they're not going to get any benefit from it. And then there's tip employees. For 2025 to 28, the first 25,000 of tip income will get a new deduction. It's also subject to phase outs at 150 and 300, and you're still subject to tax reporting and payroll taxes on that, just not income taxes. Now, this is another one of those things that the government hasn't released yet, how they're expecting this to be reported. We're all obviously hoping that this is going to show up on the W-2s, because other than that, it's going to be really tough to know. And that's also going to play into the next slide, which is same issue on overtime. Because for overtime, the first 12,500 will be deductible, and it can't impact exempt employees. So, basically, if you were getting paid by the hour before, you're going to qualify for this. If you're a salaried person, you're not going to qualify. And as I mentioned with the tips, hopefully there's going to be some reporting on the W-2. Otherwise, no one's quite sure what's going to happen with this. And, so hopefully this will get resolved quickly. Another one, which is going to involve some regulations from the IRS and from other people, is the car loan interest. Up to $10,000 of interest will be deductible from 25 to 28. And there's also phase outs on here, 100,000 for single people and 200,000 for married and filing joint. So based on that, I'm not anticipating seeing a lot of this in New England because of the high earnings. There's all sorts of rules about where the car was assembled, and it's very clear that we're going to have to get help from the car dealers who are going to have to provide information based on the VIN numbers of the car to help people figure out if they qualify for this or not. So if you did buy a car in 25 and you think you're going to hit be under the income limits, or maybe you have a child that's under the income limits, this is going to be worthwhile talking to a dealership, to the dealer to get the information to see if this can help. Next up is probably one of the more controversial things in the bill, and I admit I don't know if he wants to talk about it today. I'm assuming not, but Lyman and Rick it's the Trump accounts. As of now, there's no IRS guidance on how this is supposed to work. And to be honest, a lot of people kind of mocking the entire thing. But there are some opportunities here depending on how this all plays out. So if you have a child that's born between 2025 and 2028 who is a U.S. citizen with a social security number, the government is going to deposit $1,000 into the Trump account. Now, as I said, no one's 100% sure how that's going to happen, but it's supposed to happen. But the big thing, which once again doesn't impact 25, but it's an issue for 26, is that employers can make a contribution of $2,500. Now, this is not clear yet on if it's $2,500 per child or if it's $2,500 per employee. Obviously, if it's $2,500 per child, that's pretty attractive. But even if it's per employee, that's still pretty attractive because it's a way to give people tax-free money to their kids. The business would get the deduction, the employee would not get taxable income on it, and the money would go into the kids' account. Now, ultimately, what these Trump accounts are used for is, once the child is 18, they're basically going to be used like 529 plans, and they can be used for education. And if they're not used for education, then you can wait till, the person's, 65, 70, whatever they retire, and they can be used as IRAs. So there's a lot of speculation on how these are going to work. And with the IRS shutdown, which hopefully is going to come to an end, but obviously they have a lot of other priorities, but there's a lot of people waiting for regs on this to see exactly how this is going to work, to see if it's going to be worthwhile to do or not. And as I said, luckily, I don't think any contributions can be made until July 1st of 2026. So we do have some time to figure that out. But I have talking to plenty of small business owners who are like, hey, I got 4 kids that are all under 18. If I could put, $2,500 into each one of them, get a tax savings and, kind of start my kids, 529s or, retirement plans, it's not a bad deal. So, we're all waiting to see how those are going to work. Okay, moving on to TikTok number 2. This one I see a lot out there. The question is, can I create a piece of art, get a valuation for it, donate to a charity, and get a charitable contribution for it? And this one's a little tricky because the answer is not true, but it's also not false because you can donate art to charities and get deductions for it. Okay. The issue is that if you're doing a non-cash donation of over $500, you need to disclose it. Okay. And if you're donating something that's over $5,000, it needs to be appraised by a licensed appraisal person. And that appraisal has to be attached to the tax return. So if you're in a situation where someone in your family is a true artist and sells things at galleries and and someone can determine an actual real fair market value, then yes, I would highly recommend that you do something like this. But if on the other hand, you want to donate your child's scribbling that they made at 5 years old, I think you're going to be hard pressed to find a real appraiser to give that the valuation that you want, because they're going to be looking at jail time themselves, and and clearly they're going to lose their ability to be a licensed appraiser in front of the IRS. So it's a good idea if it's real art. If it's not real art, this is probably fraud, and you might be looking at jail time, and I would not recommend it under those circumstances. Okay, last couple of slides on the OBBBA. Um, this is another one that's kind of controversial. There's a tax credit for contributions that you're making to scholarship granting organizations. Okay, it's a $1,700 credit. Now the problem is that these organizations are designed to help lower income students. But it's very clear that the goal of the credit is to enable state level school choice programs. And there's a lot of states that do a lot of school choice, but there's also a lot of states that really fight it hard because they want kids in the public schools instead. So I admit I was really shocked that this actually made it into the bill, because I figured this was something that the Republicans were going to have to cave on, because I just didn't think there was enough people that cared about it enough. As of now, I've yet to see anyone tell me that they're making these donations. I am curious what they're going to be nationally, if this is going to be a success or not. Once again, getting back to charitable contributions, there's now an above the line charitable contribution, $1,000 for single people, $2,000 for married filing joint. This is for people that don't itemize. So as I said earlier, 2025 is probably the year to make donations, because it's going to be tougher in future years. A couple of things that are no longer available. The electric vehicle credits were repealed, so no more credits for those. Residential energy property credit, that's also been repealed. That was for people that were putting solar panels on their houses and geothermal. And the energy efficiency improvement credit is also gone. That was for a lot of like putting in windows and doors and whole house fans. That's all gone also. So with those three bad things that went away, one good thing that came back is bonus depreciation. So if you're self-employed, you have rental properties, or you own a small business, everyone's very happy to get bonus depreciation back at 100%. There's also a change to the qualified small business stock, otherwise known as 1202. If you have basically a startup business and you meet the qualifications to be a small business, it used to be a cliff. And you had to have the business for over 5 years, and then if you sold your stock, you paid no taxes on it at all. It was very, very popular. Well, now they've made it a little bit easier. Now there's a couple other breakpoints that will allow a 50% tax savings and a 75% tax savings. So once again, if you have small businesses and and you qualify as an SBS and you're looking to sell your business, you definitely should look into this to see if you're going to qualify, because this is a great way to get out of paying taxes on selling small businesses. Another one, which was very, very targeted, and I don't know if we have any musicians here, but they changed the rules for musicians to make them the same as people that were doing film and television. And now you can deduct the first 150,000 of the cost to produce a record or an album. And I will tell you, I did have a couple of clients that called me on this, and they were all excited. And I'll be honest, I had no idea what they were talking about because I, I have a lot of musician clients, but they don't actually make albums anymore. They more just kind of, cover bands, and they were showing up and doing tours at, local bars and restaurants and clubs. So, if you know anyone who is looking to make an album, that's a good one for them. Okay, so enough with that. Now we're going to go on to things to do. Obviously, we have to December 31st to maximize your 401k contributions. It's 23,500, or if you're over 50, it's 31,000. I don't know anyone who doesn't tell you to maximize your 401ks if you can. It's just a great way to save. And then the next one is if you have children that are working, be sure to fund their Roth accounts by April 15th, 2026. This one here is it is just golden for saving money for your children. I know my son, he started working at Staples at 14. He had to get working papers from the high school in order to do it. And starting at 14, I started putting as much money into the Roth as I was allowed to, because it's limited based on what the child made. And as I said, it doesn't have to be the child's money, so the parent can do it for them. So my son's about to turn 30, which is kind of frightening. But in his Roth now, he has, I think it was something like 170,000 or something like that. And it's all because, we've been funding it since he was 14. This is just I can't stress enough how much this is a great vehicle to, help provide for your children's retirement plans. As I've mentioned a couple of times, 2025 is definitely the year to put stuff into charity. And based on charity, we also have to always talk about the qualified charitable distributions, the QCDs. So if you're old enough and you have to take required minimum distributions out of your IRAs, what you can do is you can have the IRA make your charitable contributions for you. And when you do that, then your RMD can be satisfied and you don't have to pick up the income for it. So this works out really well for people that don't get to itemize anymore, because it pushes their income down, which enables them to, possibly get credits and other things and just not pay taxes on it. So, I would definitely, if you're taking RMDs, see if a QCD makes sense for you. Okay, TikTok number 3. You should create an LLC and contribute your home to the LLC. This enables you to deduct all the costs of your home in the LLC and then take the loss from the LLC on your tax return. True or false? This one is clearly false, and it's going to fall under the category of criminal. The issue with an LLC is an LLC has to have a business purpose, and just putting your house in an LLC is not going to qualify as having a business purpose. Now, I'm a big fan of people that can legitimately use a home office. And if you have a small business that's legitimate and you put it in an LLC, then you don't have to put the house in the LLC, because you're not going to get all the benefits for that anyways. You're going to get the benefits for the percentage of the house that you're using, for this business. And this is a nice thing to do. It's not a huge deduction, but hey, why pay taxes if you don't have to? So if you have a small business and you can use a home office, then definitely take advantage of this. Now, the number one question which I always get is, Gary, I'm working from home, and as you can see today, I'm working from home. Can I deduct anything? Well, the answer is it depends on what you do. If you're getting paid on a W-2, meaning you're an employee someplace, then unfortunately, no. They did away with that, with the home office deduction for W-2 employees. Now, if you're a partner in a partnership, yeah, you can take that home office. If you are a self-employed person, yes, you can take that home office. So, you know, definitely reach out to your tax advisor if you meet those qualifications to see if you can do so. It'll help a lot. Okay, further things to do. Harvest your losses. Admittedly, with the market had been up recently, so people might not have as many losses as they used to. But prior to the year end, you should definitely be doing a portfolio review to see what you could take advantage of. If you had big gains earlier in the year and you have some losses, if it makes sense to sell, sell. Then by the same token, Roth conversions. Everybody loves having money in a Roth, but the upfront tax from doing the conversion could be cost prohibitive, and it might not make sense to do it. However, if you have other circumstances, such as a net operating loss or a flow-through loss from a K1, this is a great year to do it. I admit, I get into some arguments with various financial planners, and I won't say if Lyman's one of them, about Roth conversions. I admit personally, I'm not a fan of them if you're in the 37% bracket. But get me down into the 24 or the 15 or even lower. And yeah, I'm gung ho on these every single year. And then, as I mentioned earlier, there's the bonus depreciation is back. So for businesses and self-employed individuals, you should look at maximizing equipment purchases to take advantage of changes to bonus depreciation. And then the last piece is real estate. If you purchased a property and are a real estate professional, a cost segregation study can save you a lot in taxes. My firm does those, but always be careful with cost seg studies because if you're going to be tracked by the passive activity losses, it might not make sense to do it. You might be spending money to do a cost seg and it just have the depreciation suspended into later years. So you got to make sure that you can take advantage of these. Now, as an example, I have a client that he's very heavy into real estate, and a lot of his properties are, 20 years old, 30 years old, and he's fully depreciated them. And, they're cash flowing very, very nicely, but they're all spinning out a tremendous amount of taxable income. Well, one of the things that we finally be able to convince him to do, especially because his sons are now involved in the business, is it's time to start growing. And so he's recently completed the purchase of a $4 million property, and we've done a cost seg, and we're going to be getting him about $1.5 million, maybe up to $2 million in depreciation in 2025. And that's pretty much going to wipe out all of his income for 2025. So, it's not so much the price of the cost seg, but as long as the property can break even on the cash flow, he's looking at saving about $400,000 in taxes. So, what he paid for the property was probably a little bit more than he wanted because he wasn't happy with the cash flow projections. But once we factored in a $400,000 tax savings, now he's realized I get it, and this is why cost segs make some sense. But like I said, you have to make sure that you're in the right situation to do that. Now there's sorry, I want to go back because there's one thing that didn't make it onto the slides, and I just want to talk about it briefly, and that's the opportunity zones. Okay. There's also the new type of opportunity zone for rural opportunity zones. These are a way, if you have capital gains, that you can defer those taxes and the investment that you're in can potentially be tax-free after 10 years. So this is another thing that I think people should be looking into if they have sizable capital gains that they're looking to shield. If they can find investments that make sense, and a lot of these are kind of like um, you know what I'm trying to think, mutual funds or their private equity funds that we can use to shield these capital gains. And if you're definitely in these type of situations, you definitely want to reach out to your tax professionals to, see if it makes sense for you or not. And that brings me to an end. Sorry if that was a little rushed. I was trying to keep it in under a half hour, and I was close. So, now we have some time for some questions or comments.
Great. Thanks, Gary. Always insightful every time I talk to you about taxes. Any questions from our audience today? While we're waiting for people to think about their questions, we do have a survey that just popped up in the chat there. If you can tell us what you think of today's presentation, that'd be great. One of the things that comes up for us a lot, Gary, in our practice, of course, is Roth conversions. And I'm just curious, I don't know if have you seen an uptick in people looking at this and doing it, or is it kind of the same as it has been the last few years? Just curious, like if you're seeing a trend there or not.
Yeah, it's kind of the same as it's been for years. Because, and as I said earlier, that, a lot of financial planners, when they look at the, extrapolated numbers, they make a tremendous amount of sense to do it. You know, the drawback on a lot of those calculations is that, it's not taking into account the taxes that's required to do the upfront conversion. Because a lot of times when that's happening, that tax money's coming out of people's checkbook. It's typically not coming out of the brokerage account or something like that. And a lot of times that can make it very cost prohibitive to do. So like I said, I see a lot more Roth conversions when it's a situation when we're in a low tax year or something happens that's out of the ordinary. And so the one which was one of our best home runs was we had someone that we knew was going to get a K1 with a $500,000 loss that they had basis in order to take, and it wasn't going to be suspended anywhere. Okay, so when we saw that, we immediately jumped all over it, and we did a Roth conversion of like, I think it was like 600,000, because we were like, okay, we're going to shield 500 of it with this other loss, and the taxes on the 100,000 that we were going to do left wasn't going to be a deal breaker for the taxpayer, because we didn't want to be in a situation where they were going to have to sell other assets that they had in their brokerage accounts to cover the tax. Okay, so yeah, give me situations like that. We are all over these Roth conversions. Uh, you know, I always recommend them if there's not a lot of money in the account. If someone has some sort of a legacy IRA with $12,000 in it or something like that, I would probably always do it because the tax impact is not going to be too high. But sometimes, as I said, these Roths, they could have 500,000, million, 2 million, depending on how long it's been there and how long it's grown. And like I said, that can generate a lot of taxable income, and that makes it tougher to do. And maybe if we really want to do it, we spread it out over half a dozen years, to make the tax bite easier. But for people that are in the highest bracket, as I said, I kind of question if it's worthwhile.
Yeah, I mean, we've often done proposals for clients, and like on paper, it looks like it makes a lot of sense for the client after we've done the analysis. But then when we tell them you're going to have to write out a larger check to the IRS, that just kind of stops them there, even though they know that it
Right.
could be beneficial for them down the road, because later they would pay no taxes on the money coming out of the Roth. So that's always hard. It's kind of hard
Yeah.
for some
Yeah.
people to
That's always the problem because when you look at the numbers, the Roth conversion makes so much sense. But you have to take into account people's cash flow for today, you know, rather than what their cash flow is going to be in, 20 years or, 10 years.
Mhm.
And, that's where this can become difficult.
Yeah. I guess another thought that occurs to me that is going to be a challenge for some of our clients and investors in general is that, we've had such a good year with the stock market that a lot of people are going to get distributions if they own mutual funds in particular, and those typically get uh, declared and paid in late November or December, which can be a surprise for a lot of people at year end. And it's hard to find those losses, to offset things
Yeah.
like that. I don't know if you have any other
Luckily,
ideas in that space.
yeah, I would say luckily, um, and this has just been my experience. I can't say that as they always say in the financial world, what's happened in the past is not a guarantee of what's happened in the future. But luckily, when the market tends to go up, the capital gain distributions are not as high as when the market goes down. And the reason for that is when the market goes down, people want to get out of the mutual funds. And then it means the mutual funds have to sell the securities inside the mutual funds. And that's what's generating the capital gain distributions. Okay. So whereas, you know, if you're in a mutual fund that was heavy in like, one of the good stocks, an Nvidia, something like that, they might not have sold any of it. It's like, they might be just riding that gain. And until they sell it inside that mutual fund, they don't have to pass any of that out to you. So, you know, like I said, without knowing what's happened inside the fund, which I think is, Lyman's point, it can be very shocking. If you're in a fund that rebalanced its portfolio because it was, overweighted in certain things, yeah, you could conceivably get hit hard by capital gain distributions.
I see we have a question here. Should you make a QCD at age 70 and a half or wait until it's required?
Um,
That would be, I guess, wait until the required minimum distribution
yeah,
is
yeah, I
required.
don't think it'll help you at all because I don't even know if you can do a QCD until you're required to take RMDs.
Actually, you can. You can do it at age 70 and a half.
Oh, well,
So
there
there's
you
that
go.
weird period where you don't have to take the required minimum distributions, but you can do it used to be more synchronized when the RMD age was lower, but now there's a gap of several years.
Well, my personal opinion is I would not do it. Um, unless you didn't have outside ability to make the contribution that you want to make. I hope that makes sense. If you wanted to make a $50,000 contribution, rather than taking it out of your IRA, tax wise, you'd be much better off doing it out of, a brokerage account or, personal funds. It's only once it's a required amount that it starts to make more sense to do it.
So when you do the QCD, at any point in time, it is a tax-free transaction. So it's just that when the RMDs have begun, the you're reducing the taxable portion because you have to take the money at that point.
Right.
So I know I think that might be a particular question that depends on someone's individual circumstances. And when we do these webinars, we do try to kind of address what applies more generally. So
Yeah.
that might be a question for your.
And the other thing about QCDs, and I admit I've lived through this. You got to be very careful with who you're making the contribution to and how you're doing it. I had a client, it was about 3 years ago, gave $100,000 to the Boston Ballet using their QCD, but they messed up and they got the free tickets from the Boston Ballet, which were
Mhm.
valued at like $1,500. Now, you would think that what that would mean is that you could get, well, let's just, you would think that would mean that I could get a QCD of 98,500, but it doesn't work that way. It's an all or nothing. So they didn't get a QCD at all. And what we ended up doing was instead picking up the $100,000 of income and then taking a charitable donation on Schedule A for the 98.5. Okay. And, it wasn't a complete disaster, but all in all, it did end up costing them money because of, this particular person's tax situation. That extra 100,000 in income pushed them into the top bracket. So it raised all their taxes. It phased them out of a couple of credits and things that they were trying to take advantage of. And, you know, I don't, we did the calc. I don't remember exactly how much it ended up costing them, all because of, that small, you know, token thing. Like but I've learned my lesson. I tell people, if you're using your QCD to give money to WGBH, don't even take the tote back. It's like, you're just better off just saying, here's the money. I don't want anything. Don't give me anything. If they try to give you anything, give it back. Because, when you get that letter that says, what did you receive in return? We wanted to say nothing was received. Otherwise, you're going to run into a problem.
All right. Any other questions for Gary? Well, we appreciate your time today, Gary, sharing your year-end tax tips with us. If you haven't done so already, in the chat is the little feedback survey. We hope you can take that survey before you depart today. But thank you for everyone for attending, and we look forward to seeing you on the next go round for our monthly webinars. Thanks again, everyone.
My
Thanks,
pleasure.
Gary.
I had to give everyone 10 minutes of their day back.
Thank you, Gary.
Thanks, Gary.
Thanks, Gary.
Take care.
Thanks, Gary.